On May 1st, X1, Lender Co. lent borrower $10,000 for 12 months at 12% simple interest, with interest and principal to be paid on May 30th, X2. Per accrual accounting, record all required entries for Lender Co. on May 1st, X1, December 31st, X1, and April 30th, X2. Per the revenue recognition principle, when should the interest revenue be recognized? Let's diagram this out. The loan is given out on May 1st, and then it's to be repaid with interest April 30th of the following year. That's a 12-month period. The math for computing interest is the principal, which is the $10,000 loan, times the annual interest rate of 12%, and the time period that this interest is running for the whole loan is 12 months out of the 12-month interest rate period. So that would be $1,200 per year, per 12-month period. The problem is that year straddles two accounting periods, assuming this company has a December 31st year end. So how much of this $1,200 should be in X1 and how much should be in X2? That math is also pretty easy. It's $1,200 per year, or 12 months. If you divide that $1,200 per year by 12 months, you get $100 per month. Therefore, in X1, we have 8 months, resulting in $800 of interest. The math is 8/12ths of a year. 8/12ths of this $1,200 gives us $800. The following year, it's 4/12ths of a year for $400. In total, it comes out to the $1,200 interest revenue. Now what we're going to do is do the journal entries to make sure we recognize revenue of $800 in X1 and recognize revenue of $400 in X2. This will be an accrued revenue because we won't receive the cash until the following year. On May 1st, X1, lender gave out cash of $10,000, credit to cash. In exchange, it has a note receivable of $10,000, debit to note receivable. As of December 31st, it needs to accrue the interest revenue for the amount it's earned even though it hasn't been paid yet. How much should it accrue? Credit interest revenues, $800. Now the question is, did we receive the cash and therefore debit cash? The answer is no, we didn't. So we have a receivable debit $800. We can then post that to the interest receivable ledger, winding up with a debit to interest receivable at the end of the year of $800. In the future, we should collect this $800 in cash. Next year, X2, on April 30th, lender receives a total payment from the borrower of $11,200. Why did they receive that $11,200? Let's break it out piece by piece. First off, they earned another $400 of interest revenue. Credit to interest revenue, $400. And it received back all $10,000 of the principal it lent out. So credit to notes receivable, $10,000. The difference here is $800, and surprisingly enough, you'll see it exactly matches interest receivable. So we simply had an asset, which was a debit of interest receivable last year, and now we credit that interest receivable in X2 because we've now received it in cash. When we post these to the general ledger, we credit interest receivable $800. So at the end of X2, we have no more receivables. Now let's step back and look at it. Did we get the interest revenue recognized in the correct accounting periods? In X1, we recognized $800 of interest revenue, and X2, we recognized $400 of interest revenue. Do our recognized revenues comply with the revenue recognition principle? If you look at the timing in our diagram from before, we showed that $800 should have been in X1 and $400 should be in X2 for a total of $1,200 over the 12-month period. And yes, we did comply.